Palantir just absolutely kicked everyone's ass after earnings. Revenue grew 93%, US commercial revenue jumped 149%, and the stock just took right off. Now, bef- making money is only the beginning. I had decisions to make with Palantir, with Google, with Arista, and two new positions in Visa and Berkshire Hathaway. And here's the thing, every one of these situations needed a completely different move. So today, I want to explain what I did, why I did it, and what we're going to be watching next. Before we get into it, I am not a financial advisor, and none of this is financial advice. There are real trades we're taking inside of practical income portfolio for education. Options involve risk. You can lose money, and your goals and risk tolerance may be completely different from mine. So please do your own research before making any investment decisions. People spend all their time trying to find the next stock that's going to be going up. But once you're actually sitting on a trade that is a big gain, the harder question becomes, what the hell do you do now? Do you hold it? Do you protect it? Take profit? Turn it into income? Move the money somewhere else? There isn't one automatic answer here. My Palantir leaps were sitting at just under 100% gain, and Palantir had grown to roughly 15% of my total portfolio. So I sold the leaps, locked in the profit, and used that money to buy 80 shares. Now that gave me a designated 100 share income position. While I still own additional Palantir shares, I removed the leverage options exposure, kept the bullish stock exposure, and now I'm creating the ability to sell covered calls. That was my plan. I wasn't abandoning Palantir. I'm changing the job of part of my position. Now, the average cost basis on those 100 shares was $155.91. My target is to generate roughly $200 to $300 a week in covered call premium when the trade setup makes sense. Now, that's the target. It's not a promise. I'm not forcing a covered call on a down day. I'm not taking some lousy strike price just because I want to collect premium. So, for example, if I was looking at the 170 strike around that 20 delta area, if those shares were called away at 170, I'd still make $14.09 per share on the stock, plus whatever premium I collected. That's a damn good outcome. The point isn't to grab the highest premium available. The point is to choose a strike where I'm genuinely comfortable letting these shares go. All right, so my Google position needed a different decision altogether. I entered these leaps at $58.10. So the contracts had reached $102.20 at the time of this video, and that was a 75.89% unrealized gain. I moved my stop to 98 with a 97 limit. Now that's pretty tight protection, and I understand exactly what that means. If the $98 stop triggers, it creates a limit order at $97, and it does not guarantee the contract will sell. If the option drops below $97 too quickly, that order may not fill, and I could still be holding that position. But at this stage, I'm willing to risk getting stopped out because protecting a monster gain here has become more important than giving the trade unlimited room. All right, then there's the Arista networks. I had made money on this position over the last few months, but honestly, I wanted to keep it. But we decided to remove the earnings risk, and then Arista took off after earnings. Watching that happen after selling, it felt pretty damn lousy. But I still made money, and removing the earnings risk was a deliberate decision. The stock exploding after you sell it doesn't automatically mean that the original position was stupid. It just means that I accepted an opportunity cost and in exchange for moving the event risk. Sometimes disciplined risk management still feels like crap afterwards. uh, we can learn from that result without rewriting history and pretending the profitable trade was a complete failure. So that's my what I did on Arista. Great Plan, bad outcome, kinda. All right. After selling Arista and some other positions and using a little dry powder, we bought Visa and Berkshire Hathaway Class B. Compared with Palantir, these are boring as hell. But boring doesn't mean weak or dead money. I mean, Visa just reported 14% revenue growth, 10% payment volume growth, 13% total cross border volume growth. That's one hell of an operating quarter. Berkshire's first quarter earnings increased nearly 18% to about 11.35 billion. These businesses are producing right now, but they also reduce some of the concentration in my higher volatility technology names. Their job is steadier compounding and portfolio balance, not trying to become the next Palantir by Friday. So that's the lesson. Palantir became a bullish income position. Google became a profit protection decision. Arista became a realized gain with some painful opportunity cost. And Visa and Berkshire became diversification and redeployment positions. Several profitable trades created four different jobs and four different decisions. Portfolio management isn't about finding one rule and blindly applying it to everything you own. On Friday, I'll be giving you the full practical income portfolio update, including where these positions stand, what changed, what I did, and what comes next. If you want to follow these trades from entry through management and exit, subscribe and come back for that update. So until then, protect your capital. Don't chase some damn thing just because it's running. And see you in the next one. This video, I could have made this into a 45-minute video probably, trying to explain all these different theories and the trades that I made. But the thing is we wanted to make this a little bit of a shorter video and be able to explain some other things on Friday. But I appreciate you guys watching, and we'll see you in the next one.